What's up, everyone? It's Scotty with Money Vesting. So quite an interesting day for the markets. We were gapping up a little bit. We were even higher intraday, but as soon as the Powell testimony began, we pretty much started rotating back lower. We tried to drift higher a little bit. It was a lot of back and forth, but eventually we ended up red on the day as Jerome Powell once again threw in the towel, threw in the reality check, put pretty much cold water on our rally, something we have discussed in our previous videos, and a lot of things related to higher interest rates and for longer, and continuing on his hawkish tone, which is what we did discuss in our live streams as well. Since inflation numbers came in super strong and super hot in the month of February for January, we literally talked about this in our live stream. I mentioned that I would not be surprised if Jerome Powell is hawkish into this meeting, considering how hot the numbers were in January for inflation. So, Fed Chair Powell says interest rates are likely to be higher than previously anticipated, and the Fed funds futures also flipped. We are now pricing in a full 50 basis point hike in March. So March 22nd is when the next meeting is. Tomorrow, we've got another testimony from Jerome Powell. I will be live once again to cover that, and he's going to be speaking in front of the U.S. House of Financial Services Committee. So that is also going to be very, very important, and the market's definitely going to be moving on what he has to say. So hope you guys enjoy this video. Find it helpful. If you do, don't forget to subscribe and, of course, hit that like button. The link to our Discord and Patreon is going to be down below if you're interested in joining us, and, of course, getting access to all the buy and sell alerts, options alerts. Speaking of options, my Tesla call option now is up over 83%, just a little bit more, and I will be closing that option out for a good profit, but the link is going to be down below if you're interested in joining us. And of course, getting access to all the swing trading ideas and a lot of other private videos as well. So moving along here, Chairman Jerome Powell on Tuesday cautioned that interest rates are likely to head higher than central bank policymakers had expected. And he says, and I quote, "If the totality of the data were to indicate that faster tightening is warranted, we would be prepared to increase the pace of rate hikes." And Powell said the current trend shows the Fed's inflation fighting job is not over. So Jerome Powell on Tuesday cautioned interest rates are likely to head higher than central bank had expected, and citing data earlier this year showing that inflation has reversed and the deceleration it showed in the late 2022. The central bank leader warned of tighter monetary policy ahead of slow growing economy. Now, again, I've mentioned this before that, we had a very strong inflation numbers in January. And Powell, for many people who believe that cares about employment, cares about the economy, really need to wake up. They need to wake up to the fact that Jerome Powell has no emotional sentiment towards employment or economic growth, right? Even though Elizabeth Warren pretty much asked him point blank, Jerome Powell, what do you say about what do you say to the 2 million people that are going to lose their jobs, that are currently in jobs right now, that are possibly going to lose their jobs by the end of this year? To which he pretty much responded that, obviously he's talking more broadly, and that's not their goal. That's not what they're targeting. They're not looking for people to lose their job. They're trying for a soft landing, but it's going to become more and more challenging as time goes on, as they keep raising rates, as eventually, as it's known to be, something will indeed break. And he says the latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rate is likely to be higher than previously anticipated. If the totality of the data were to indicate the faster tightening warranted, we would be prepared to increase the pace of our rate hikes. And those remarks carry two implications. One, that peak or terminal level of the federal funds rate is likely to be higher than previously indicated from the Fed officials. And two, that the switch last month to a smaller quarter percentage point increase could be short-lived if inflation data continues to run hot. And the next inflation reading is going to be next week, and March 14th is going to be very important for the next CPI print. If, for any reason, if CPI ticks higher, month over month we go up, and year over year we tick up, it's game over. It's absolutely game over, because the Federal Reserve is not going to stop until inflation's back under control. We've talked about this before. This should not come as a surprise to anybody watching this channel. There's no need to speculate anymore. In the first of his congressional hearings, Powell said outright that the Fed might raise interest rates higher and faster than officials had projected last year. His exact words, quote, "The latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. We would be prepared to increase the pace of rate hikes. This means that rates could not only go beyond 5.25%, but Fed could also return to the 50 basis point hike." And now the probability for a 50 basis points hike is 72%. So obviously much higher than what we are known for, like what we are used to seeing. Earlier, it was closer to 72% for 25 basis points. And what's even more interesting is that the terminal rate expectations have increased so much that the 6% level is now at 33% by September. And remember a few weeks ago when I did a video talking about the 6% probability and everybody was like, hey, Caddy, that's such a low probability. You should really not do a video about it. Well, guess what? 2 weeks later, we are now at 33% probability that rates are going to go up to 6%. So bottom line is, like I said, inflation is a pretty strong leading indicator for the Fed. And if that doesn't come into control, unfortunately, nobody has any idea how high rates are going to go or how high they can go and for how long, right? So Kathy, we're predicting, Fed is going to start to pause rates and start cutting rates, or anybody else predicting that interest rates are going to pause and they're going to move, back lower. What we need to understand is inflation's got all the shots. Inflation is calling the shots, right? If inflation doesn't come down, you have to make a prediction on inflation, not on interest rates. Because if inflation doesn't come down, interest rates are not coming down, right? So that's kind of like a positively correlated thing. And inflation, yes, we did get some good data points, November, December, we had some good disinflation, but January was pretty much a little bit of a reversal. And that's also what Jerome Powell said, that, we saw a bit of a reversal in inflation numbers in January. They ticked higher, especially PCE. Core PCE sitting at 4.7, year over year sitting at 5.4 on a headline basis. So they're still pretty high numbers and, pretty higher than what the Fed's target is. So that's exactly one of the reasons why the Federal Reserve is still pricing in. And now it looks like we are pricing in 50 and then another 25 and another 25. So pricing another 100 basis points or 1 percentage points in hikes for the remainder of 2023 and then a few cuts priced in 2024. The bottom line is that this narrative could change. This could continue to get flipped a little bit further higher. This could continue to be pushed higher if inflation doesn't come down. That's the main thing here. So White House endorses a new Senate TikTok bill, urges Congress to pass it quickly. So White House threw its support behind a new bipartisan Senate bill on Tuesday that would get Biden administration the power to ban TikTok in the U.S. And this is actually coming in much faster than what we had anticipated. It's actually in motion. And the legislation would empower the Commerce Department to review deals, software updates, or data transfers by information and communications technology in which foreign adversary has an interest. And TikTok, which has become a viral sensation in the US by allowing kids to create and share short videos, is owned by Chinese internet giant, of course, ByteDance. And the bill has been dubbed Restrict Act, which stands for Restricting the Emergency of Security Threats that Risk Information and Communications Technology. So they're definitely moving in fast with this bill here. We'll see what comes out on the other end, but it's going to be quite interesting. And this was the state of the market, of course. Absolutely bloodbath here, coming off of the recent highs and just so much selling pressure. We tested down over 3%. Google selling off, Microsoft, Apple. We got Meta slightly down, Amazon slightly down, Nvidia's pulling back. AMD kind of held up a little bit better. We had energy, industrials, healthcare, financials, basic materials, utilities, everything selling off here with a lot of pullback in all sectors. All 11 sectors in the S&P 500 were red, at least 1%, if not more. And in the last 1 week, we got communication services, the only leader along with energy and technology. Industrial utilities still a little bit higher, but everything else is straight up down. And over the last 1 month, we've got energy that is slightly higher, but everything else is down in the last 1 month. Lean hogs and orange juice for the win. Coffee prices, sugar prices pushing higher. And then we had oats, canola, ethanol, natural gas, and cocoa pulling back as well. And Bitcoin here just a little bit past 22,000. And Ethereum just trading over 1,500 at the moment. So, I want to really address what the market situation is because I feel like there's still some confusion here. The bottom line is that inflation is a leading indicator, right? Inflation is not coming down still, right? It is still pretty sticky, right? So I'm in the camp of a bit of a stagflation type environment where inflation continues to come down. There is some disinflation, but it then starts to go sideways, right? It doesn't really fully come down to under 4%. But then it starts trading sideways as we continue to see some increase in prices and relatively higher prices, so to speak, from about a couple of years ago. So we enter kind of like a stagflation type environment for inflation. Now, with respect to the economy, I've already mentioned that I don't expect 2023 to be like this insane, growth here for gross domestic product. In fact, I do expect GDP to contract a little bit in the coming quarters. And along with that, as consumer spending starts to pull back a little bit and we see debt levels continue to rise, but at some point the savings rate are depleted and the debt levels are no longer able to be serviced, I do expect the actual unemployment rate, which is the real unemployment rate, right? Looking at unemployed persons with respect to the participating labor to actually start moving up as well. The Federal Reserve themselves have a projection of 4.1, 4.5% by the end of this year. I wouldn't be surprised if it's a little bit higher, closer to 5.5, maybe even 6%, depending on how severe this potential recession gets in 2023. So that's one of the things that I've, try to get across, is that just because the markets are pushing higher doesn't take away from the fact that the economics, the macroeconomics are still pretty unresolved. And I've tried to caution, everybody that, it is really important to understand what's going on with inflation and what the Federal Reserve is doing with interest rates, because markets have a tendency of pushing higher and just kind of making you forget about all those things, right? And only focusing on the gains and the greens and going to the moon and just like, hey, we're back to all-time highs. Nothing can go wrong now. That is a very, very dangerous game, because you are completely ignoring or pretty much subconsciously blindsided by some of the things that are more important in the economy, and that is inflation, interest rates, unemployment, and the fact that the S&P 500 trading at such levels, what is going to be that earnings per share, and what's that PE multiple that you're trading at. So very important stuff. And I will continue to kind of provide you guys with data and facts and some of the things that are really important in my opinion. But for me, what I personally believe as of right now with the data that we have at hand is a little bit of a stagflation type environment, where inflation continues to trade sideways, doesn't fully come down to the Fed's target, but instead stays a little bit elevated, a little bit higher than the Fed's target, and then starts trading sideways. And unemployment and the GDP continues to deteriorate over the course of 2023 as interest rates continue to go higher and stay higher for majority of 2023. So that's where we stand with my personal analysis. Let me know what you think about the macroeconomics and where you believe we're headed in terms of the economy and inflation and interest rates. But looking at the markets now, S&P 500 obviously lower, down a little bit over 1%. We had the NASDAQ pulling back a little bit over 1.7%, so selling off quite a bit here on the day, trading as low as 11,530, so down actually a little bit over. So S&P was down 1.5% right now, and we've got the NASDAQ pulling back a little bit over 11,500, so down about 1.25%. So we had S&P 500 down more than the NASDAQ. That was quite interesting. And the Dow Jones here selling off a little bit over 1.7%. So lots of selling pressure in the value stocks with respect to growth. But nonetheless, all three indices were pretty heavily down. And the 10-year yields were up to 3.99%, with volatility pushing up over 5% on the day, getting past over 19, almost 20 levels. Oil prices, once again, get a rejection here. I mean, that's like a textbook pattern. Once again, get a bit of a rejection resistance here at roughly around $80, $81 per barrel and selling right back down. And Ethereum here also just consolidating sideways in and around 1600. And we got Bitcoin just trading at 22,000, starting to kind of break down a little bit from that support at the moment for Bitcoin. Talking about yields, yields here on the day, they were mostly higher for the most part. So if you take a look, they have been pushing up, and now the 6 months trading at 5.3%. It's the premium on this is insane. Like, it's risk-free rate. If it gets up to 6%, like, there's really no debate. There should really be a good flight to quality. In other words, you're getting a risk-free rate at 5.36%, like depending on how high these rates go. Versus an earnings yield on the S&P that's at 5%. I mean, there's really no debate. For rational investors, for larger investors, there's really no debate. It's like the easiest choice they'll ever make in the short term, of course. Over the longer term, we know equities will and have outperformed the bond market. But in the short time, like in terms of your allocation, your sizing, and your positioning, bonds are definitely very, very lucrative in this environment. Now, the dollar index also moved higher. We talked about it during our live stream. Big move on the dollar here, pushed up a little bit over 1.27%, back over 105. and that's putting some additional pressure on equities and of course stocks. But talking about the S&P 500 now, seeing a little bit of a rotation back down. Yesterday we talked about a bit of a shooting star candle where we had a lot of sellers step in at those highs, and that was a lot of weak momentum from the buyers. And today we had a pretty big red candle and coming back down to that 200 simple moving average. That's going to be the level to watch at 39.40 for S&P 500. NASDAQ, on the other hand, also coming down. Again, there was a lot of sellers stepping in yesterday for the NASDAQ, and we pretty much sold right back down. And today, down another 1.25%. So next support really is going to be that 200 simple moving average at 11,400. That's going to be the level to watch. And, bottom line is that, oh man, I still don't have a lot of confidence in the markets on the upside. The risk reward going into today is definitely a little bit more leaned towards the riskier side because think about it this way, right? S&P at 4,000, you're still paying 19, 20 times PE multiple, right? You're still paying that expensive of a PE multiple. In some cases for individual stocks, for Nvidia, Tesla, you're still paying 50, 70, 80 times earnings multiple. So what has changed? Nothing really, right? The valuation is still pretty expensive. From its October lows, it's rallied 19, 20%, the S&P 500. And the macro picture is literally the same, right? Unemployment's still low, economic growth is still there, and interest rates are still going higher, inflation's still a problem, right? So those four things still literally the same, and yet the markets have pushed up on the anticipation that the Federal Reserve will indeed pause and pivot, but that's not coming anytime soon. Not at least not what I think is going to happen, at least in the middle of this year. Maybe in the middle of this year, we see the economy enter into a recession in 2023, and that's when the Federal Reserve will have to really make some serious decisions, whether to support the economy or whether to continue on their fight for inflation. But that's the dilemma. That's a big dilemma that the Federal Reserve will have, and they're really hoping that by the time the U.S. economy enters a recession, inflation's already lower. That's the bet they're making right now. That's literally the bet in a nutshell they're making, that by the time the U.S. has a recession and by the time the unemployment rate starts to go up, inflation is back down. So they can at least support the economy and support the labor market by lowering interest rates. But if both of them happen at the same time, if there's high inflation and high unemployment, well, good luck. Good luck. I don't want to be in Jerome Powell's shoes if that ends up happening. But we'll see, what the Federal Reserve ends up doing. But next up, we're going to talk about Apple. Apple here on the day, pulling right back down. We talked about a resistance in roughly at 157, 158. So that is going to be a pretty strong resistance to watch for Apple. And right now, we are seeing a bit of a pullback on the stock. And 200 SMA sitting roughly at 146, 147 is going to be the one to watch. Amazon here, on the other hand, was pretty much flat on the day, outperforming pretty well as compared to the market and its peers. Resistance is going to stay put at that lower high and that 200 SMA in roughly 109 to 110. And support level, of course, inside this green rectangle, that's going to be the one to watch for Amazon, sitting roughly at around $83, $84. Talking about Tesla, and Tesla here starting to pull right back down, still trading in the context of this bull flag, so not taking away from the fact that it's trading inside that range. Still moving sideways, and the support level is going to stay put at 177. So there is still maybe a probability that it starts to break out of this level and actually gets that bull flag breakout. But support level next is going to be 177. That's going to be the level to watch, and I will most likely be closing out on my covered calls on Tesla that are up close to 83, 84% once it gets down to 177 or lower, because then the calls would be up like close to 90%. Next up, we're going to talk about PayPal, and PayPal here on the day is starting to rotate back lower, down about 2.4%, trading under $75. This is the gap that it needs to fill on the downside, and we still have a resistance sitting at the 200 SMA and the lower highs for PayPal at roughly around $81, $82, and we got a very strong support sitting roughly at $67, $68 per share for PayPal. Talking about Square, and Square here also pulling back after getting rejected at $83 per share. So this right here was that resistance for this company, and right now we're starting to rotate back lower for Square. And again, it does trade a little bit of an expensive valuation. I do like Square, though. I did like their earnings that they reported, but next support is going to be down to that 200 SMA, and roughly it's $70, all the way down to $58, $59 per share for this company. Talking about Nvidia, and Nvidia here continues. Look at this negative divergence and the higher high. It is absolutely getting rejected at this level. Honestly, this starts to become a little bit of a prime spot to be shorting Nvidia, but the momentum is just so strong on the upside for this stock that you're just going to have a tough time kind of timing it right. but it is about, negative divergence, similar to what we saw before, hitting that higher high, extremely overvalued in terms of the price of sales and price of earnings. But Nvidia is just so reluctant. It's the most stubborn stock I've ever seen. It just doesn't want to come down. It's crazy. So again, that's going to be the higher high, sitting roughly at 240s. We've got a rejection couple days in a row, 241, 240 at those levels. So that's going to be that resistance and support kind of in line, be at roughly 190 and closer to 170s for Nvidia. Talking about advanced micro devices, AMD somehow managed to close green, so huge outperformance for AMD here on the day. But this is the overall uptrend, higher highs and higher lows, and this is going to be that higher high, kind of in line with that 300 simple moving average, sitting roughly at 89 to 90 bucks, and we got the higher low sitting right over here as well for close to $73-$74 per share for advanced micro devices. Talking about Meta platforms here, Meta here coming down a little bit, 21 basis points, so just a little bit under 185, and getting a bit of a rejection here at this resistance that we talked about in our previous videos. And we got a gap to fill on the downside. We got a lot of support at the 200 SMA. So technicals do make a lot of sense for Meta right now. After coming down, pushing right back up, and now getting a rejection here at 188 for Meta. Support level is going to stay put at roughly 168 for this company. Talking about Netflix, and Netflix also continues to break down a little bit, down about 1%, so coming down to this higher low at the moment, and we are seeing, again, very oversold conditions for Netflix with the RSI, the MACD, so again, it's not going to surprise me if we get a bounce from that 300 SMA, get a little bit of a lift back up from these higher lows for Netflix. Talking about Google, and Google here starts to come right back down. Mentioned during my live stream to definitely have a stop loss at the low of yesterday's candle. So again, starting to pull right back down, and a lot of these trade ideas again are dependent on very much with the cooperation of the macros and of course the index levels. If indexes are coming down pretty aggressively, the entire market selling off, then really the technicals cease to make sense for the short term, and as a result we start to roll right back down. 3 days of very nice greens for Google, but as soon as Jerome Powell's testimony came through, Powell obviously put down the hammer here with higher rate hikes, and Google's down 1.5%. So still a pretty good sort of probability of this continued reversal to the upside with the MACD crossing over that signal line. So we got that first green histogram with the RSI pushing up as well. But of course, if the markets continue to pull back here, considering the macros and what Jerome Powell still has yet to say on Wednesday, then I wouldn't be surprised if Google also rotates back lower. But we still have a target and a resistance sitting roughly at 104, 105. For Google, with the support sitting roughly at $87, $80 per share. Talking about Microsoft, and Microsoft also pulling back. I did a video on Microsoft earlier, so make sure that you do check that out. I am absolutely in love with their technology, and I do believe that they are really going to make a dent in Google's search engine ad business. But the way the ChatGPT is taking off like wildfire, I believe that this has a lot of legs, a lot of potential for growth, and to reignite some of that earnings growth for Microsoft moving forward. So definitely check out that video and let me know your thoughts, but lots of consolidation sideways. Valuation's still a little bit rich and high. Like I would definitely be considering this now in the 220s, not so much in the 200s. So definitely been upping that fair value a little bit for Microsoft. Next up, we've got Shopify, and that's the last one. And Shopify here coming down a little bit over 2.3%. Next support really is going to be sitting roughly at $41, $42 per share. So that's going to be the level to watch. And right now, valuation is still a little bit more expensive. But at closer to $29, $30, I would be very much interested in Shopify as a potential long swing trade for the company. So hope you guys enjoyed this video and a complete update on the markets. Quite an interesting day and still more to come. We got Jerome Powell once again at 10 a.m. Eastern. I will be live to cover that, so it's not over yet. So let me know your thoughts down in the comment section below. As always, if you enjoyed this video, found it helpful, make sure that you drop a like, subscribe to the channel, and the link to our Discord and Patreon is going to be down below if you're interested in joining us. As always, happy investing. I'll see you all in the next video.